Every investor dreams of finding the stock market, where they may earn huge profits and bigger returns. The fundamental goal of any investor is to profit from an increase in share value. But there are other ways to make money and turn a profit in the stock market. Investing in dividend stocks has been discovered to be a good and simple way to generate a steady and consistent source of income. Hello 101 community, welcome back to our YouTube channel. In today's video, we'll explain the benefits of dividend investing. We'll also go over how to generate enough yearly income from dividends to retire early in the shortest amount of time. Now, let's start with the video. What is dividend investing? Investing in dividends is a strategy for purchasing stocks of businesses that reward stockholders with regular cash distributions as a benefit of ownership. Along with any increase in your portfolio that results from the rising value of your portfolio stocks or other assets, dividends can offer a steady income stream from your investments. How does it work? Dividends are sums of money given to shareholders by a company. You receive a percentage of the company's profits when you purchase stocks that pay dividends, which might assist you in generating money. Companies often distribute cash dividends on a quarterly basis, and the dividend amount may increase as the company's earnings rise over time. Dividends can be paid from the company's retained earnings, which are similar to a savings account with accumulated profits over time. Companies may also distribute dividends in the form of equity shares rather than cash. Example of dividend investing. Consider making an investment in a business that offers a 4% dividend per share. You would earn $4 in dividends if you owned one share of the corporation, which is worth $100. However, you would get $800 in dividends if you held 200 shares. The computation looks like this. 100 share price divided by 200 shares equals $20,000. Times by 4% or 4 cents equals $800. It's crucial to remember that whenever a dividend rate is mentioned, it usually refers to an annual dividend rate. If the dividend were paid out quarterly, your payout would be divided by 4. So using the same share price and share count from the previous example, your dividend payout would be $200 every quarter, $800 divided by 4. You might have heard the term DRIP, Dividend Reinvestment Plans, DRIPs. As long as you choose wisely when you buy, investing in dividend-paying companies may pay off over time. A DRIP, or Dividend Reinvestment Plan, may exist at some businesses. If you have a DRIP, you may decide whether to take your dividends as cash or reinvest them to acquire new shares. When your dividends are low, either because the company is expanding or because you don't own a lot of stock, this might be a smart strategy. How to start dividend investing. Try to find high dividend yields. This is the traditional dividend investment approach. Here, the emphasis would be on long-standing, slow-growing businesses that generate a lot of cash flow and offer substantial dividends. When you want to make money right now, these sorts of investments make sense. Recall that high yields alone aren't everything. The firm's stock values could not increase as quickly as those of businesses with smaller dividend yields. Deciding on high dividend growth. Longer-term investors should concentrate on purchasing shares in firms that are expanding swiftly but are now paying dividends that are below average. In the near term, this won't produce as much revenue, but as a company develops and its operations become more established, the dividend yield should steadily increase. By investing early, investors may purchase more shares and ultimately generate greater dividends. This is a superior long-term investing plan since the cost on yield is lower. Pursue dividend capture. A more active, hands-on method of collecting dividend revenue is called dividend capture. With dividend capture, it is not essential to hold business shares for the whole year or the full quarter in order to receive the dividend. Instead, you use the opportunity to acquire them just before the dividend is distributed. Then after receiving the payment, you sell them once more in order to purchase further stocks. The ex-dividend date, which is normally 2 weeks before the dividend is paid, must have passed in order to be eligible for a quarterly or yearly dividend payment. The next step is to decide when to sell after the dividend has been paid. As a result of the share's volatility and potential decline in value once the dividend is paid, this becomes difficult and dangerous. Such a drop in the share price makes it simple to lose all of your dividend income, if not more. Additionally, dividend capture might result in short-term capital gains that are taxed at the higher regular income rate even if the value of your shares rises. This is true even if you trade outside of a tax-advantaged retirement plan. Let's take a short break. If you like the video so far, press the like button and subscribe to the channel. Also, if you want to develop yourself financially and want to take your future into your own hands, check the links in the video description. You can also support the channel by visiting our merch shop and buying one of our products. The link is also in the description. Define your investing strategy. Your time horizon, your financial objectives, your risk tolerance, your tax bracket, and your time restrictions are the primary factors to take into account when developing your investing plan. These are two basic methods of investing based on this knowledge. Passive investing is a buy and hold investing technique that allows you to DIY your assets for optimal efficiency over the long term. In other words, you don't have to hire a pro, you can do it yourself. The main objective of a buy and hold strategy is to purchase investments and hold them for as long as feasible. You concentrate on time in the market rather than trying to time the market. Active strategy for investing involves purchasing and selling according to market conditions. You have the option of managing your money yourself or hiring a professional manager. The opposite strategy is used in active investing, which aims to maximize returns by making more frequent and deliberate purchases and sales. Select your investment account. After deciding on your investment plan, you should pick a starting investment account. Choose whether you want to handle it on your own or with expert assistance. If you wish to invest passively and do it yourself, you can have a look at robo-advisors that utilize algorithms to make investments for you. If you wish to begin actively investing, you can make use of Vanguard Actively or Fidelity. You should think about a number of aspects when deciding whether to invest actively or passively, and whether to do it yourself or hire a professional. Consider the overall costs, the time commitment, and any account minimums. Utilizing their employer-sponsored 401k is often the simplest option for many people to start investing. Ask your employer whether they will match a portion of your contributions when you get started. The most important step is to create an investing account. Select one that works with your spending plan and investment philosophy, and then make your first contribution. Just keep in mind that at the time of submission, your funds are in a cash settlement account and not yet actively invested. Manage your portfolio. Start managing your portfolio right away. That intends purchasing stocks, ETFs, or index funds from your account using the relevant codes. Your money is genuinely invested at that point. But you want to keep building your portfolio, so think about setting up automatic payments each month. Any profits or dividends can also be reinvested to support long-term growth. By making investments in a variety of investment vehicles and sectors, you may diversify your portfolio. Beginner investors often do better with a buy and hold strategy. Day trading might be alluring, but it can also be quite hazardous. Finally, you should rebalance your portfolio once a year at the very least. Your asset allocation, or the proportion of your portfolio that is invested in stocks, bonds, and cash, will have changed as your portfolio increases and decreases. Resetting it to the desired proportion is the essence of rebalancing. Rebalancing involves periodically purchasing and selling investments in your underlying portfolio to ensure that specific target weights remain constant over time. Consider the scenario in which you are an aggressive investor who holds 90% of your assets in stocks and 10% in bonds. Those weights will fluctuate over time as stocks and bonds perform differently. Without routine rebalancing, your portfolio can consist of 95% equities and 5% bonds, which does not correspond to the account's planned financial objectives. Although there is no ideal moment for rebalancing, some financial experts advise doing it every quarter. Conventional wisdom is that doing it at least once a year might be beneficial. Risks of dividend investing. Dividend investing, like all other investing strategies, involves risk. The fact that dividends are never guaranteed poses the largest danger. Companies can, and often do, cut or even stop paying dividends. Some extremely well-known, venerable stocks have fallen during the COVID-19 epidemic, including Wells Fargo, Dick's Sporting Goods, Carnival, Goodyear Tire and Rubber, HSBC, Airbus, and Rolls-Royce, to mention a few. There are other, more subtle hazards, though. Any investor should always prioritize diversity, and someone who places an excessive amount of emphasis on dividends is likely to overlook certain industries and business categories that are essential for effective diversification. For instance, young, rapidly expanding IT businesses typically don't pay dividends. Investors are consistently exposed to higher volatility when they lack diversity. Investors that focus primarily on dividends may miss out on high-value growth in industries that don't always pay dividends or pay them at low rates. So, 101 community, thanks for today's video. If you want to see more videos like this, subscribe to our channel and click on the bell icon so you will be notified of every update. Also, do not forget to check out the links in the video description. Watch our video appearing on the screen. We are sure this will also help you on your path to financial education. Thanks for watching.